So when you have your real estate license, when you actually start working as a developer, we've talked this semester about economics and how land is developed over time. Now we're going to get into the nitty-gritty of what a financial cash flow looks like, not only because it's going to help you understand how numbers work, but when you're talking to an investor, when you're talking to your developer, when you're talking to other agents like yourself, you kind of want to know what you're talking about. You just don't want to be pulling out a dictionary all the time. So on page 4037, they actually have a little apartment building. Obviously it's an apartment building that's not located here because it's really, really cheap. So on there, there's a couple things that we need to keep a watch on. So our gross scheduled income, or GSI, is all of the rent, only the rent that is coming in from the units that have been occupied and rented during the course of 1 year. All these numbers are going to be annual. The other income is other income from, let's say you're charging extra for parking, you're charging extra for laundry, or you have a laundry room in the apartment building, or you have, if it's a commercial property, let's say you have some coin-operated machines where you're actually selling Cokes and foodstuffs and things like that. When you add these two together, that's when you get your total gross potential income, or GPI. What happens is you're taking the rental income plus the other income and getting this number. And all numbers after this point start from here, because this is your actual income in the annual basis from this one property. If you notice, on this particular property that's in the book, they have a vacancy loss of 5%. Normally, most buildings will have a 3% vacancy rate. The Internal Revenue Service, the IRS, will usually allow you to have a 3% vacancy rate on your taxes. But in this case, he has a 5%, which means he probably had a few renters that moved out at the same time and they lost money. So this is how much money they actually lost. This equals the total potential income minus your vacancy loss equals your gross operating income, or GOI, and that's 185,820. What we want to do is we want to subtract our annual operating expenses, which in this example is 43,100, to come to our net operating income, which is 142,720. Your net, these numbers, your important numbers are your GSI, your potential, and here comes the operating expenses, because we want to know how much they're actually spending money on. And then this really is super important because we want to know what they're actually getting after their expenses in income. The reason is if we see that our annual expenses are pretty high, we know that there's a way to add income revenue by reducing our costs to raise the net operating income. Once we have that net operating income, we have to subtract our annual debt service. This is our mortgage payments for the year. And in this case, they're doing 126,370. And once you subtract your income minus your debt service, they're only making before cash tax flow, BCTF, of 16,350. Now this doesn't seem like much, and actually it's pretty low. This property is not in California, obviously. It's in another state that they use as an example. But also, this is the first year of their statement. This is the first year that they've owned the property. So they haven't made a lot of money yet, and I'm going to show you why in a second, okay? Once we have this before tax cash flow, now we can figure out what our tax benefit is. And if you look at the information on page 437, what you do is you take that net operating income, we're moving this number up, and we're subtracting the mortgage interest that is paid. Remember what we talked about earlier. You're in your first year, and really the first 3, 4, 5, 6, 7, 8 years, your mortgage payment is almost 90% interest. The bank wants their money first before you start paying the principal, okay? So in this case, since it's the first year, you can see they paid 126 and the interest is 119, so about 90%, okay? Then we take our minus our depreciation, the tax write-off. We covered that last week where we tried to estimate how much we could deduct for the wear and tear on the property as per tax code. And in this case, they did it for the one full year, they get $38,760, which comes to a taxable income, and in this case, the taxable income is 0. And the reason is because even though they have the net income and they're doing this and they're doing that, it actually adds up to exceed, to make a 0. So they don't have any taxable income. Well, what's the point? Well, here's the point. They still have an income. If we take their estimated allowable loss, which is left over from $15,740, and we multiply it by their tax bracket. Most folks are going to be 10% in the state of California. They're going to be 28% on the federal level. So if you multiply that number by 0.38, it equals that they've saved taxes of $5,900. So they've saved money. Even though they didn't make money, taxable income, they made money because they have technically a loss. They've actually saved money on their taxes. We then take this before tax cash flow, we move this over because this is actually income that we have. Do you understand? This is income after we've subtracted our operating expenses and we got our net income and then we paid our debt, the mortgage. We still had $16,000 of income. We take that over here, we add it to that. On paper, we've actually made $22,331, okay? This is why it's so important to own an income property and also try to either refinance or do that 1031 exchange that we talked about before, which is you want a lot of this interest because this is a huge tax deduction, okay? Don't be an investor. Don't allow your clients to be an investor that hold on to something for 30 years because they lose that depreciation, they lose that interest write-off, and now all of a sudden this 0 becomes a lot of money that they owe the tax man. This is why a lot of investors, they always refinance within usually 7 to 10 years if they're going to keep the property or they try to sell the property and boot that cash, boot that income to a bigger property like we talked about in the previous class, okay, on a 1031 exchange. The income is one thing, but the tax savings that you have with an income property is huge, especially if you are married and you have a family and you're trying to save every penny. Buying a house is one thing, but buying an income property with all the tax savings is a whole nother ball game, because what you've done here, and this is just in the first year, you've saved your family $6,000, $500 a month. That's not bad. But you've also had an income of about $16,000. That's not bad either, okay? But being able to earn $22,000 on a simple investment like this is a huge impact for anyone, whether they be the investor, the developer, the business owner, whatever the case may be, okay? So when you're talking to your clients, when you have that real estate license, when you're working in commercial or residential or whatever you're doing, even if you're going to be using your license to go work for a personal banker, a private client banker, and you're talking about real estate, you need to understand this, okay? Because they're gonna wanna see it on paper. And what I'm gonna do is, I'm gonna show you towards the end of class, it's an actual 10-year projection on a property I just did for a client. And it's actually a breakdown that'll do all these numbers for you, and it'll look really impressive for your clients, okay? Does anybody have any questions on this?
So the before tax cash flow is the actual.
This is the actual money you made.
Yeah, and that saving tax is the kind of like
Right, this is what you saved from paying taxes, okay? Simply because you could write off your interest and you could write off your depreciation on the property, which produces a zero taxable income. And I know, all of you except for 2 people are from other countries, so I don't understand how your tax situation works in your country. But in this country, this is why people buy income property, is to save taxes, to have an income that's passive, and to become wealthy, okay? Yes?
So that 22,000, that's what you're netting out the first year.